Business entities are legal structures through which individuals conduct commercial activities, own assets, generate income, and manage liabilities. The choice of business entities significantly affects taxation, legal responsibility, management authority, continuity, and financial planning opportunities. Financial planners must understand the characteristics and tax implications of various business structures because entity selection influences income taxation, retirement planning, succession planning, and wealth accumulation strategies. Common business entities include sole proprietorships, partnerships, limited liability companies, LLCs, S corporations, and C corporations. Each structure provides distinct advantages and disadvantages regarding taxation, liability protection, administrative complexity, and operational flexibility. Proper entity selection helps business owners achieve both operational and financial objectives efficiently. A sole proprietorship is the simplest and most common business structure. It is owned and operated by a single individual and does not exist as a separate legal entity from its owner. Business income and expenses are generally reported directly on the owner's individual income tax return, making taxation relatively straightforward. While sole proprietorships offer ease of formation and management flexibility, they also expose owners to unlimited personal liability for business obligations. Financial planners evaluate whether the simplicity of a sole proprietorship outweighs potential liability concerns. For many small businesses, this structure provides an efficient starting point but may require modification as the business grows and risks increase. Partnerships involve two or more owners who share profits, losses, responsibilities, and management authority according to an established agreement. Partnerships generally do not pay income taxes at the entity level. Instead, income, deductions, gains, and losses pass through to the partners, who report their respective shares on individual tax returns. This pass-through taxation avoids the double taxation associated with certain corporate structures. Partnerships may be organized as general partnerships, limited partnerships, or limited liability partnerships, each offering different liability protections. Financial planners help business owners evaluate partnership arrangements, ownership structures, and tax consequences to ensure alignment with operational goals and long-term planning objectives. Corporations are separate legal entities that provide owners with liability protection and continuity of existence. C corporations are subject to entity-level taxation, meaning corporate earnings may be taxed both at the corporate level and again when distributed to shareholders as dividends. This is commonly referred to as double taxation. Despite this potential disadvantage, C corporations may offer benefits such as broader access to capital, enhanced credibility, and expanded employee benefit opportunities. Financial planners evaluate whether corporate structures are appropriate based on growth expectations, ownership objectives, compensation strategies, and tax considerations. Corporate taxation remains an important factor when analyzing business planning alternatives. S corporations combine certain advantages of corporate liability protection with pass-through taxation. Subject to specific eligibility requirements, S corporations generally do not pay federal income tax at the entity level. Instead, profits and losses pass through to shareholders and are reported on individual tax returns. This structure may provide tax planning opportunities while avoiding double taxation. Limited liability companies, LLCs, offer additional flexibility because they can often choose among multiple tax classifications depending on circumstances and planning objectives. Financial planners frequently recommend LLCs and S corporations for closely held businesses due to their operational flexibility, liability protection, and potential tax advantages. Trusts and estates are separate legal entities that play important roles in wealth transfer, asset management, and estate planning. An estate is created upon an individual's death and exists temporarily while assets are administered and distributed according to a will or applicable law. A trust is a legal arrangement in which a trustee manages assets for the benefit of designated beneficiaries. Trusts may be established during life or upon death and may serve purposes such as asset protection, wealth preservation, charitable giving, tax planning, and beneficiary management. Financial planners integrate trusts and estates into broader financial plans to facilitate efficient wealth transfer and achieve long-term family objectives. Income taxation of trusts depends largely on whether the trust is classified as a grantor trust or a non-grantor trust. In a grantor trust, income is generally taxed directly to the grantor because the grantor retains specified powers or interests. Non-grantor trusts are separate taxable entities that may pay taxes on retained income. Income distributed to beneficiaries is generally taxed to the recipients rather than the trust itself. Estates similarly may be subject to income taxation during administration. Financial planners evaluate distribution strategies carefully because trust and estate tax rates often reach higher marginal brackets more quickly than individual income tax rates. Understanding the characteristics and income taxation of business entities, trusts, and estates is essential for comprehensive financial planning. Business entity selection affects liability protection, operational flexibility, and tax efficiency, while trust and estate structures influence wealth transfer, asset management, and beneficiary outcomes. Financial planners analyze these entities within the broader context of income tax planning, retirement planning, succession planning, and estate preservation strategies. Appropriate structuring can improve after-tax outcomes, reduce administrative burdens, and support long-term financial objectives. By understanding the taxation and characteristics of various legal entities, clients can make informed decisions that enhance financial efficiency, preserve wealth, and facilitate successful transitions across generations.